Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 5th of December 2024. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, in the first step, let's have a recap what has taken shape yesterday in terms of relevant news flow, economic data release, and the intraday performance of the broad-based cross asset classes. So let us start with the relevant news flow and economic data release first. So yesterday, we do have a important economic data that is centered on the state of affairs of the US economy. And this is an important data because it's one of the leading macroeconomic indicator for the US. So we are talking about this ISM Services PMI. So ISM Services PMI is a survey-based format economic indicator. That means ISM Institute send up a list of survey questions seeking out responses from the key purchasing manager of the services industry in the US. And we know that the US economy, close to 3/4 of it is driven by services activity. So for services PMI, that's indicating services activities growth in the US economy grew at a slower pace for the month of November. So it came in at 52.1, below what market is expecting at 55.5, and below 56 that was recorded in the prior month of October. So if you look at the growth trend of the services PMI for the month of October, the 52.1 reading for November is the slowest rate of expansion in the last 3 months. All right, so let's give it a bit of seconds for it to load. Right, so it dipped down over here. So if you look at the 3-year trend, it's kind of slowly deceleration in terms of the growth trend at 52.1. All right, and that also accompanied by a so-called ISM subcomponent, the employment component, which is also pretty much watched by market participants because that actually indicate how hiring trends in the services activities or the services industry in the US. So if you look at the services employment subcomponent within the main headline PMI, also decelerate from 53 to 51.5. So market is expecting at 53 a similar pace of expansion in terms of hiring prospects in the services industry from the previous month of October. So at 51.1 over here, all right, it also starts to actually inch down lower as well. All right, slightly lower. Okay, so but net overall, that actually didn't derail the optimism that is being persistent post-Trump election win, right, for the major US stock indices. So the major US stock indices continues this uptrend and also being supported by positive seasonal factor as well as we head into the month of December, where in December it tends to be positive for the major US stock indices monthly performance based on historical price action norm in terms of the seasonality factor. And also on top of that, what's also supporting this ongoing optimism in the major US stock indices is by encouraging Federal Reserve official, the boss himself, Fed Chair Powell, public speech yesterday, where he see no reason solid economic condition cannot continue. So based on his public comments, he has a view that the US economy is still in a Goldilocks scenario, and the October 18th of December FOMC meeting is more or less has been penciled in for a potential interest rate cut. So if you look at the latest CME Fed Watch 2, based on the current pricing, as compiled by data from the Fed Funds futures market. Market is still looking at a high chance of 74% that the Fed will introduce another interest rate cut on the 18th of December FOMC meeting, which is a 25 basis point cut to bring it down to 4.25% slash 4.5%. So that's almost unchanged, the Dow, prior to Fed Chair Powell remarks yesterday. Right, it's almost the same as the previous day at 73%. And what market is expecting going forward in 2025, that will actually all plays out on 18th of December as well, because on 18th of December, the Fed will release its latest dot plot. That means this latest dot plot consists of future Fed Funds official median forecast slash projection on the state of the US economic growth in 2025 and including 2026, as well as inflationary trend for the same period 2025 to 2026, and most importantly where the Fed Fund will be next year as well, and as well as 2026. That means longer term projection. And if you were to look at the aggregate Fed Funds futures pricing as compiled by the CME FedWatch tool right now, based on whatever current available information, this is not live, but it's slightly about 1 to 2 hours delayed based on the pricing of the Fed Funds futures. Market is still looking at a rather shallow space out interest rate cut trajectory for 2025. So market, after expecting the third rate Fed cut to come in the 18th of December meeting to break down to 4.25% to 4.5%, then the Fed will start to maintain or stamp at in 29th of Jan next year meeting, only introduce a potential cut of 65% probability, so that's quite high, or 63% probability, pardon me, that's quite high, to come in at 19th of March, okay, FOMC meeting. Then thereafter it will stamp at and will potentially introduce another cut in 30th of July 2025 meeting. All right, bring it down to 3.75% to 4%. Then thereafter, it will remain on hold until the end of the next year. All right, so it's a rather spaced out and shallow interest rate cut trajectory as expected by the pricing of the Fed Funds futures contract right now based on the CME FedWatch 2. All right, so will this Dow change? Definitely. After 18th of December, market participants will be hearing up their ears and eyes, watching out for any changes in the dot plot, and as well as hearing Fed Chair Powell views on the state of the economy, especially Trump's incoming American First policy that could potentially increase inflationary pressure in US in 2025. Okay, but that doesn't derail the short-term optimism of the US stock market. So we could see is that the US major stock indices, the four of them continues to be in their persistent short-term uptrend phase, where the SPX, the Nasdaq 100, the Dow Jones, and the Russell 2000 all gain positively yesterday. So the outperformer is the Nasdaq 100, up by 1.24%, and the SPX secondly 0.64%. Both the SPX and the Dow Jones Industrial Average, both the SPX, pardon me, and the Nasdaq 100 reached fresh record high again yesterday. The Dow Jones Industrial Average revisited its record high before backtracking slightly. Later I'll share you the trend of the Dow Jones Industrial Average. The Russell 2000 still hasn't made a fresh all-time high, but its short-term uptrend trajectory still remains intact. Right. As for the euro dollar traded almost unchanged yesterday. So initial bounce was being kept by the outcome of the this France government that has already been toppled down, has been forced out by the far right party Le Pen, who support a no confidence vote. All right, so right now we will start to see France political instability or uncertainty, as Macron now needs to try to find a new government to pass the 2025 budget. So the reason why the Le Pen forces out the current premier, this is the current prime minister appointed by the France president, is because he does not adhere to her party requests on certain aspects of the budget. So there's this no confidence votes that is being pushed, and it was successful to actually topple the current France government. So what we could see over here is that the France credit risk of holding France bonds still continues to remain elevated by looking at this particular chart over here. So this chart I do flash out in this week, one of the intermarket dynamics, all right, that is playing out right now. We start to see a bullish. Okay, so this little line over here, this green line is where the outcome of the France legislative election that led to the hung parliament, which lead to this result of a no confidence vote that is being pushed out yesterday. So what we could see, okay, let me hide this. Okay, so what I could see is that we start to see a bullish push up on the yield spread by the 10-year sovereign bond yield against the 10-year German bond. All right, which is the sovereign bond in short, the German bond. So as long as this yield spread continues to be expand on the upside after this major bullish breakout that took shape on the outcome of the second France legislation election, the second round in the summer months this year, there is a big negative feedback loop that could be indicated, that could actually continue to play out on the FX market, where we see the euro dollar inching downwards as this yield spread continues to increase on the upside. And also the more sensitive euro Swiss cross pair potentially could start to see lower low as well, okay, as the credit risk premium of holding sovereign bond increases based on the yield spread that it continues to expand against the 10-year German bond. So the next resistance to watch on this yield spread will be at 0.98%. So upon hitting this 0.98%, it could potentially lead to further downside pressure on the euro dollar and the euro Swiss. So that actually explained to us why the initial rebound on the euro dollar was muted yesterday upon the outcome of the successful no confidence vote that's been pushed out by the far right party to topple the current France government. So something to look out for as we head towards the weekend of this week. All right, on the FX market. So what we could see on the gold itself, also gold was sideways, almost unchanged, still remaining the 2066 short-term pivotal resistance that we highlighted. That means gold price right now is being stuck in a wedge between heightened France uncertainty in terms of political. So we know gold thrive in terms of major economy political uncertainty or geopolitical risk premium has starts to increase. So the geopolitical risk premium indeed has now starts to be more on the high side than the downside in the eurozone because of this France uncertainty that is taking shape right now. But however, gold price is also being concerned about future inflationary pressure that may slip into the US economy, and that starts to lead to a less generous accommodative policy undertaken by the Fed in 2025. All right, right now. And oil price right now, it seems to be falling suit to the kind of buy the rumor, sell the news effect. So we know that oil price prior on Tuesday shoot up by 2% because of this rumor that today will be the outcome of the OPEC Plus ministerial meeting, where OPEC Plus as a group could potentially announce a further delay in the supply hike plan instead of keep on pushing down the road down the can into March next year. All right. But that has really been priced into the market, and we start to see oil price actually tumbled yesterday. All right, later I'll share failure to break above the 70.18 short-term resistance level, which I'll highlight later on the West Texas crude oil. And also what's interesting over here is that the US-China trade tension has started to get ratcheted up again ahead of Trump inauguration on 20th of January. So yesterday, Beijing actually announced that they will actually ban these two key raw materials to America market. And these two raw materials, germanium and gallium, are required for US semiconductor supply chain product. All right, so it's a tick for tat measure right now. So it seems to us that the US-China trade tech war may start to lead to a US-China raw materials war going forward. And that also doesn't bode well to the China stock market and its proxy Hang Seng indices. So as you could see over here is that the Hang Seng indices, the HSI, the Hang Seng Tech, the HSCEI, all are now recording or trading in the red as we speak. And the China mainland market is almost unchanged at 0.02%. Okay, later I'll touch on more on the Hang Seng Index, or the Hang Kong 33 we call it, as it failed to actually have a clearance above the 20-day moving average and starts to trade downwards right now. Okay, what are the key levels to watch? Stay tuned later for the short-term technical segment when I cover the major stock indices. All right, that will be the key news, data, event, and the respective relevant broad-based cross asset classes intraday performance for yesterday. All right, so now let us now jump straight into the intraday technical outlook segment, starting with the FX market first. All right, so let me kickstart with the euro dollar. All right, over here. So with that, let me expand my screen so that you guys could have a better view on the chart. Right, so on the euro dollars, this is what it means, that the earlier push up fails to break above the first resistance zone that I highlighted yesterday at 1.052 1.0530. All right, over here 1.05230. Okay, this level here, this red line here, if you have to break above, which is also slightly with the 20-day moving average that is coming close to it as well. Okay, so what I'll do over here is that I will not use this level as my short-term pivotal resistance level because it's a bit too tight, just in case of that whipsaw. I will adjust it slightly lower to the from 1.0630 to this last Friday minus swing high area, not at 1.06 figure level. So as long as 1.06 figure level holds, I will still maintain that intraday bearish bias on the euro dollar. Next near-term support level to watch will be 1.0410, but however, on the intraday basis, I could adjust it this level here that was being tested yesterday, 1.0470, followed by 1.0410 level. Okay, a breakdown below 1.0410 level will kind of reinforce the impulsive downward sequence to resume, revisiting the minor swing low of 22nd of November in first step at 1.0330. Only an hourly close above 1.06 tightened short-term pivotal resistance for today will invalidate today's intraday bearish bias on the euro dollar to see the continuation of another potential leg of mean reversion rebound taking shape, exposing the next near-term resistance zone of 1.0660/1.0680 over here. Only a breakout above 1.0680 potentially sees the extension of the next leg of the potential mean reversion rebound scenario, unfolding to revisit 1.0770, which confluence with the downward sloping 50-day moving average. Very similar movement on the sterling dollar. So the sterling dollar yesterday pushed down, again almost hit the first support zone before rebounding back up to hit the first resistance level at 1.2710. So still no change there, using 1.2750 as my short-term pivotal resistance level. Still maintain that intraday bearish bias on the sterling dollar, but first support zone to watch out for remains unchanged at 1.2610/1.2580 over here. So only a breakdown below 1.2580 will potentially increase or reinforce the next leg of the impulsive downward sequence to come in for the sterling dollar to expose the next near-term support zone at 1.2460/1.2440 next. However, if price action starts to shape a bullish breakout and hourly close above 1.2750, that would invalidate today's intraday bearish bias on the sterling dollar to see the continuation of the mean reversion rebound taking shape, exposing the next near-term resistance level at 1.2840 and potentially even this 1.2960 next. Right, so that's for the sterling dollar. Now, the turning of attention will be the Aussie dollar. So the Aussie dollar continues to remain lackluster, hit the first support level at 64.10 before shaping a bounce. So what I could see over here is that price action still remains lackluster at this juncture. So I will, for a better risk reward ratio perspective, I will tighten the key short-term pivotal resistance for today from 65.10 to 64.80 over here. So as long as 64.80 short-term pivotal resistance holds, we'll still maintain the intraday bearish bias on Aussie dollar. First support level to watch for sure will be at 64 figure. A breakdown below 64 figure exposes the key major support level at 63.60. So what's 63.60 again? Let's have a quick recap on the daily time frame. So on the daily time frame, 63.60 is the lower limit of this major pivotal support zone. 63.60 previously managed to survive the sell-off on 5th of August, survive the sell-off on 19th of April, and as well survive the sell-off on 13th of November last year. And also it's coincide the lower limit of this major ascending trend line that is in place since 13th of October 2023 low, right? So this is the lower zone of this important pivotal support zone at 64 figures slash 63.60. So if price action managed to have a daily close below 63.60, that means it's indeed starts to shape a major bearish breakdown. And with this major bearish breakdown away from this consolidation that was previously seen from the low of 13th of October, could potentially trigger the start of a multi-week to multi-month downside movement on the Aussie dollars. So, but in first step on the intraday basis, the support level to watch out for will be at 63.60. All right, then thereafter we see how the RSI momentum indicator evolves upon hitting the 63.60. All right, whether would there be some form of bullish divergence that could lead for a minor bounce thereafter. So we got to keep a close eye watch as price action continues to develop as it head towards the 63.60 level on the Aussie dollar. Only a price breakout with an hourly close above 64.80 will negate the bullish tone, or will negate the bearish tone, pardon me. I repeat, only a hourly breakout with a close above 64.80 will negate the bearish tone on the Aussie dollar to see a squeeze up to revisit 65.10 again, which is the downward sloping 20-day moving average as well. Only a push up with above 65.10, then we will have a higher odds to see another round of mean reversion rebound unfolding in the Aussie dollar, exposing the next near-term resistance at 64.45 and even 66 figure next, which correspond very closely to the 200-day and the 50-day moving average. So that's for the Aussie dollar. Now, turning our attention will be the dollar yen. So dollar yen yesterday did a very nasty vicious push above our short-term pivotal resistance at 150.70 before reintegrating back below it. And this morning it tries to do another breakout, but failure to attempt to break above 150.70. So yesterday, this little push up here was a failure bullish breakout that managed to be kept right exactly at the 50-day moving average, acting as a resistance level as well. So what we could see over here is that price action on the hourly RSI also remains weak as it's continued to shape a series of lower high as well, and attempting to now break below the 50 level mark. So net overall, our view yesterday push up as a failure bullish breakout, using now 151.90 slash 152.15 level as my short-term pivotal resistance zone, also correspond to the 200-day moving average as well. All right, so I don't want to push so tight just in case it get another whipsaw again at 150.70. So 151.90 slash 152.15 short-term pivotal resistance levels still maintain that intraday bearish bias on the dollar yen. First support level to watch out for will be at the 148.85 level for today. All right, 148. No, in fact, I do have a, because it's an intraday basis. So this level here. Okay, 149.60 followed by 148.85. All right, this minor congestion area here, then followed by 148.85. Only a push up with an hourly close above 152.15 will invalidate the intraday bearish bias to see a further squeeze up or a further extension of the mean reversion rebound to revisit the next intermediate resistance at 153.30 slash 153.70, which confluence with the 200-day moving average acting as a resistance. And if you were to do the Fibo retracement of this entire down move from the high of 20th of November, that also corresponds very closely to the golden ratio of 61.8% as well. Okay, so that's for the dollar yen, still maintaining a bearish bias, but with an adjusted short-term pivotal resistance level, just in case of any potential vicious whipsaw again at 151.90 slash 152.15. Now that sum up the intraday technical outlook on the major FX pair. So let us now focus on the major stock indices, starting with the Hong Kong 33. So I did mention earlier that Hong Kong 33 has failed to have a proper surpass above the 20-day moving average, which also did that bearish reaction right exactly as our short-term pivotal resistance that we highlighted yesterday, 19,880, right? So it hit our first support level, 19,470. Why this support level is important? Because it is the ongoing running minor ascending trend line that is still in place since 26th of November. So still no change for these two key levels. Short-term pivotal resistance 19,880. First key intermediate support level 19,470. You got to have an hourly breakdown below 19,470 to increase the odds of the intraday bearish bias, revisiting 19,080 next. Right. However, if price action starts to push up and have an hourly close above 19,880, then this potential mean reversion rebound scenario could potentially extend, exposing the next near-term resistance level at 2,150 and potentially even 2,490 next. So still maintaining that intraday bearish bias on the Hong Kong 33, 19,880 for sure will be the short-term pivotal resistance level to watch because it did a bearish reaction of it yesterday. Downside trigger level remains unchanged at 19,470, where potentially it got to have an hourly close below it to ignite more bearish pressure for the Hong Kong 33. Now, turning our attention will be the Japan 225. So the Japan 225 almost staged that rally as expected and almost come close to the upper limit of that complex range configuration that is still in play since the low of 27th of September this year. All right, so this is still a complex range configuration that is still in play. So since it's coming very close to the upper limit, in terms of a better risk reward perspective, and also how the RSI evolves right now, it starts to shape that bearish divergence. Okay, upon price action hitting a higher high yesterday. With that, we will flip to a intraday bearish bias right now, using the upper limit as my short-term pivotal resistance level to watch for today, 40,155 slash 40,280. First support level to watch will be a breakdown below 39,380, potentially exposing the next near-term support zone at 38,830 slash 38,670 in the first step, which is also confluence with this 20-day, 50-day, and the 200-day moving average. All right, so only a push up with an hourly close above 40,280 will potentially see a bullish breakout of that complex sideways range configuration that has really taken shape in about close to 2.5 months to revisit the next intermediate resistance at 41,050, which is this minor congestion area over here from 12th of July to 15th of July. Yes, so i.e. On the Japan 225, flipping to a intraday bearish bias close to the upper limit of the complex range configuration at 40,155 slash 40,280 for now. Okay, with that, let us now take a look at the German 30. So the German 30 continues to exhibit bullish price configuration, at least in the short term. But right now, it hit the upper limit of this minor ascending channel. So there could be a potential minor pullback taking shape. So this minor pullback, I will have a tightened key short-term pivotal support level to watch. So a breakdown below yesterday's US session low, which is 20,155, potentially may see a much more steeper minor pullback. So as long as this steeper minor pullback managed to hold at 20,010 level, all right, 20,010 level. Okay, let me do a Fibo retracement from this current push up from 27th of November all the way up to yesterday's intraday high that correspond to the 23.6% Fibo retracement ratio as well, which is this minor congestion zone of 3rd of December and 4th of December. So as long as this potential minor pullback that could take shape today, given that it hit the upper limit of this minor ascending channel, as long as it hold above this 20,010 short-term pivotal support level, Titan one, potentially we may start to see some form of further potential bullish movement on the German 30. So still keeping that intraday bullish bias. Okay, so still maintaining that intraday bullish bias after this potential minor pullback take shape. As long as hold above 20,010 level, potentially the next resistance level to watch out for after will be 20,390 slash 20,470, which is pretty key level. Why? Because that confluence with a Fibo extension level. And as well, if I go to the daily chart, over here is the upper limit of this major ascending channel that is in place since 3rd of October 2022. So that is a 2-year channel. right, ascending channel. However, only a price action breakdown with an hourly close below 20,010 that would invalidate today's intraday bullish bias to see a much more deeper minor mean reversion rebound scenario taking shape, exposing the next near-term support level in the first step, 20,815, 19,690. So a breakdown below 19,690, potentially see it extending all the way down to retest the 20-day and the 50-day moving average, I think as a support level at around 19,430 zone. All right, so that's for the German 30. So still maintaining that potential intraday bullish bias with a tightened key short-term pivotal support at 20,010 after a potential minor pullback that may take shape. Right. So now turning our attention will be the major US stock indices, starting the US Wall Street 30. So the US Wall Street 30 yesterday continues to shape a bounce right above our short-term pivotal support level that we highlighted earlier, 44,520. So still no change as price action didn't have a proper breakout above the current all-time high area at 45,070. So first support level to watch will be at 44,730, unless today we have an hourly close above 45,070, that I could tighten my short-term pivotal support level at 44,730, or else the key level still remains unchanged. Above 45,070 sees 45,450 next. All right, so still maintaining that intraday bullish bias on the US Wall Street 30 using 44,520 as my short-term pivotal support level. Now, turning our attention will be the Nasdaq 100. So Nasdaq 100 hit our resistance level at 21,500 with the RSI at the overbought region over here right now. Potentially there could be a minor pullback. So minor pullback, first support level to watch will be yesterday US session low at 21,350. So as long as this minor pullback didn't surpass below 21,220, we will still maintain that intraday bullish bias. So this 21,220 very key. Previous all-time high that was tested earlier at the start of this week before shaping that bullish breakout to see fresh all-time high going forward in the last two sessions. So as long as this minor pullback didn't surpass below 21,220, tighten short-term pivotal support level for today, we will still maintain that intraday bullish bias on the Nasdaq 100. Next resistance level to watch 21,650, followed by 21,770 with confluence with a Fibo extension, as a Fibo extension cluster zone as well. Only a price action breakdown below 21,220 with an hourly close below it will invalidate today's intraday bullish bias to kickstart a much more pronounced mean reversion decline scenario, exposing the next support level at 21,100, followed by 20,970 slash 20,880, which confluence with the rising 20-day moving average as well. Okay, so that sum up the intraday technical outlook on the major stock indices. Now, turning our attention will be the commodities market, starting with gold XAU slash USD. So gold XAU slash USD continues to trade below the 50-day moving average, which is the 20,660, 20,666 short-term pivotal resistance level that we have since last week. So still maintain the intraday bearish bias within this sideways range configuration. First support level to watch will be 20,622, only a breakdown below 20,622 exposes 20,600 to, okay, 2,600, pardon me, 2,590. Okay, so I repeat again, short-term pivotal resistance remains unchanged, 2,660 slash 2,066. Maintain that intraday bearish bias within this minor sideways range configuration that is playing out. Minor sideways range configuration lower limit, which is the support level to watch, will be 2,622. Only a breakdown below 2,622 exposes 2,600, 2,590. However, if price action managed to have an hourly close above 2,666, today's intraday bearish bias were invalidated to see a much more pronounced recovery in the first step towards the next intermediate resistance level at 2,689, followed by 2,728, 2,715 for gold XAU slash USD. All right, so now lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we do have a bullish bias with a first resistance coming in at 70.80. So the first resistance almost hit. Failure to have a breakout above it will also correspond to the 50-day moving average, I think as a resistance as well. I think as a resistance as well before price action shape that bearish breakdown, bearish reversal, and breaking down below or reintegrating back below the 20-day moving average acting as a resistance now, intermediate resistance now at 69.30. So with this bearish price action that evolved in the West Texas crude oil yesterday, ahead of today's OPEC Plus ministerial meeting outcome, which is likely to be announced before the start of the US session or even much earlier, but the time is not fixed. They could actually announce much later as well. Potentially, oil price could see further downside using 70.80 as my short-term pivotal resistance level. Further downside potential support level to watch 67.90, followed by the upper limit of the major range support zone at 65.55/65, 67.55/67.10 level. However, if price action starts to integrate up again, that means there could be a potential messy choppy movement above 70.80, invalidate today's intraday bearish bias to see a push up towards 71.80 and the crucial medium-term resistance level at 73.15, where price action can't break above it since 24th of October this year. Right, so that's West Texas crude oil flipping back to a bearish bias after the first resistance almost hit at 70.80 yesterday, using 70.80 as my short-term pivotal resistance level. All right, so that's also sum up the intraday technical outlook on the broad-based cross asset classes. So before we end today's daily dose session, let's have a quick look at the economic calendar on the key events that could impact the movement of the broad-based cross asset classes. So today, other than the OPEC Plus meeting, for today, what are the data to look out for? For today, will be this retail sales from Eurozone for the month of October that were out at 6 p.m. Singapore time. And we have in US itself, we have we have a couple of second tier US job data to take note of. US challenger jobs data, 8:30 p.m. Singapore time. The weekly continued jobless claim data, 9:30 p.m. Singapore time over here. And thereafter will be a quiet session followed by 12:30 a.m. We have a Federal Reserve official speaking. Fed Banking will be speaking at 12:30 a.m. Singapore time. And at 1 a.m. Singapore time, we have a BOE officials, Greenie. She'll be speaking at 1 a.m. Singapore time. All right. And also into the early Asia session tomorrow that could potentially impact the Nikkei 225 and as well as the dollar yen rate will be at 7:30 a.m. Japan household spending and average cash earning for the month of October. That'll be out at 7:30 a.m. Singapore time. All right, so that should sum up. Yeah, that should be the key data to watch out for today and early tomorrow Asia session. So with that, I wish you all a great day ahead and we shall speak again tomorrow. Thank you.